So if you would, please join me in welcoming Professor Xiao Zhang.
I think it works. All right. I want to start by thanking Peter for this opportunity here to basically, the way I feel it is to discuss with my colleagues and to basically share with my colleagues some of the thinkings I have regarding all this valuation, and in particular this thing called accounting-based valuation formulas, basically different valuation models. How would I think about these models? How do they differ? And that's basically it. So what I'm going to talk about basically is, laid out all these different accounting-based valuation models, and talk about their difference and how, if you go ahead and use it in research and or practitioner, what kind of the thing that you need to take into consideration in choosing these models and how to implement that. And I will also talk about some of the problem I think that's in this area that I think that should be addressed. What this valuation, I think my talk is what Peter told me, the emphasis is on the valuation model. So I'm not going to touch about financial statement analysis, but basically is kind of the second step. Once you do the financial statement analysis, it's the next step. You need to bring those analyses and put a dollar value and come up with a valuation of the formula, of the valuation of the company through certain formulas, and this is what I'm going to talk about. As you're aware that there are a lot of these different models, so my emphasis will be how to choose from them, what's the key difference. But pretty much what I take here is accounting perspective. We're accountants here, and I'm not going to talk that much about the related finance side of it. To organize our thinking about all these models, you have to realize a lot of these different models come from just bottom line the same thing. It's basically the discounted dividend. The value of a stock equity equals to present value of future discounted dividend. Put it there just to starting point for us to organize our thinking regarding all these different models. Now, starting from the dividend discounting model, and then people start to deviate from that, is to bring in earnings into the picture. Basically, rather than dividends, you forecast earnings, but there is this thing called, what I put at K, is a so-called dividend payout ratio. That's sort of a traditional map from earnings to dividend. Okay? And that's basically you discount future earnings, and there's a payout ratio, and that's the thing you need to forecast. Now, the next model I want to talk about is the same, what I call an earnings growth model, or abnormal earnings growth model, is the paper published by Olson, and I apologize, I really don't know how to pronounce that, so I will just refer to it as what other people did, call it OJ model. So what this OJ model is a different kind of approach to type future earnings into value. Rather than you say, here's the earnings, the dividend payout ratio, basically you have a certain thing, this YT. What essentially is the price, well, bottom line with this model, you forget all the math, what the model boils down to is the following. Basically, you take a forecast 1 year earnings out, and you capitalize it. That's the sort of the benchmark. By capitalizing, I mean you ask yourself, what's the value of the stock should be to generate that kind of earnings? That's the first term, basically capitalized earnings. And then you tag along all these additional terms. What this additional terms is meant to capture is, what if the future earnings, that's the earnings 1 year down the road, doesn't capture everything? And these additional terms are meant to just capture all these additional terms that's not there, captured by the first year earnings. And the other model I'm going to basically throw out and talk about is you probably all aware of this residual income model. Rather than discount dividend, discount earnings, what you now do is discount future so-called residual income. You take the book value plus residual income, where residual income is basically how earnings, what you earn on top of what basically the benchmark. So, with all these models, one question that you can feel about also during Jeff's discussion, and kind of the question that has been bothering pretty much everybody is, why do we care? Because if you think Steve Penman wrote a paper in 1997, basically if they're all the same thing. They got to be the same thing because they're developed from the same thing, dividend discounted model. But that somewhat creates a problem for many people is that you go out and sell I have this fancy residual income, and then you turn around and tell them they're the same thing. Basically the same as discount dividend. And that's not going to work. I think there's one thing in my mind that we need to sort out is what I think actually is pretty intuitive, that it matters in the sense it's not even though they derive from the same underlying principle, if you take Infinite Horizon, they're all equal to discounted dividend, which is basically there. But they're not the same in the sense there is this issue of forecast horizon, which Jim and I had this paper in 1999 talk about this forecast horizon. Why does that matter? Let me give you an example. Generally when you do an equity valuation, you do forecast, you don't forecast to infinity. This issue of forecast horizon is very familiar, that if you actually do it, you cut it off somewhere down the road. You don't forecast to infinity. But I think it's a mistake to motivate this approach as if that you're just lazy. You can forecast infinity. You can forecast basically to a state where the firm will grow constantly. They call it constant growth stage. It's wrong to think about the analysts can actually forecast to the steady state and they choose to cut it off because they're lazy. They just want to cut it off in 1 year. That's not the case. What I think actually happened is actually intuitive in the sense, if you do financial statement analysis or equity valuation, the one thing that you got to keep in mind is you got to start with something. That is, you believe there's something that you know better than the others. Okay? And the other thing you got to remember is that you don't know everything better than the others. So for instance, if you take a company like Qualcomm, you may think, all the others might underestimate this true impact of the third generation cell phone, which Qualcomm make the chips. And I believe maybe 10 years down the road, all the cell phone will have a GPS cell in it, and basically one unit. So if you believe that way, then you go ahead and say, how do I value this company? You do the forecast, then you face the problem. That is, you may know better about basically the sales side, but you may not know the cost side as better as the others. So what you're going to do is when you sit down and forecast, suppose you do your forecast to infinite horizon, what's going to happen is you put in the model something that you know better, which is the sales. But on the other hand, if you don't know the others, if you have to put in your cost figure, that may actually noise it up quite a bit. In the sense, if you forecast, the longer you forecast, the longer the noise that you introduce by using your not so good knowledge about the cost, it's going to dilute basically your advantage regarding one piece of the analysis, of basically whole evaluation process. And that's basically the whole idea of you truncate your forecast in the sense, well, if I have this knowledge about revenue, if I forecast 5 years down the road, I may not have that much a good job in the sense, I just don't know that much about the SG&A, the cost structure. But you ask yourself, well, if I go, say, 1 year ahead, my advantage in forecasting the sales may still do a good job. So on average, 1 year forecast earnings, I still have it better than the others. So if you start from that point and then you say then I do valuation, That's where you cap it. You cannot forecast infinity. Suppose you can only use basically, say, the 1 year earnings forecast, and you use that to do valuation, and this is where all these different models come into place. That is, you don't do valuation forecast. You have to cut it off with a finite horizon. Then what's the model? What's the ingredients of the different model you use to do the valuation? Excuse me. All right. So enough about the motivation. So that's, in my mind, if you want to get a good understanding of these different models, you need to keep in mind this finite horizon issue. So now you look at all these models with a finite horizon in your mind, and you say, basically, this discount model is sort of what Steve Penman in his paper is what you essentially do. You forecast certain years, and you estimate something called the terminal value. If you take dividend, or equivalent to free cash flow, you just multiply the terminal dividend or free cash flow. Or you multiply, if you take the PE model, you multiply the terminal earnings with something. Or a little bit fancier, that is, I try to say all this model where they differ is you start with the dividends, then say, I move to earnings, but have to forecast about the so-called dividend payout ratio. If you have a good sense that my forecast of dividend payout ratio is better than that guy, then use the second model. And now, if you are more forecasting, you say, I have a good sense of growth and dividend payout ratio, then you use this constant growth model. And that leads to basically with this OJ model with finite horizon, this is basically what's going to boil down to. If you cut down in a finite version, you assume this, remember the ZT term that tag along. If you assume that one grows constantly after certain years, this is what you're going to come up with. This is basically a truncated version of that model. Okay. Finite horizon of the residual income model is basically you suppose you say 1 year down the road. Beyond that, residual income is to roughly grow at a constant rate of what the value is going to be. So if you want to use this model, basically you have to have the book value, earnings, a kind of a growth rate for the residual income. You all know about this. So what I want to point out is you need to keep in mind that in choosing these models, one thing to note is all these models involves progressively more data. In the sense, remember the situation I talked to you about. Basically, if you have a good sense of, say, dividend, but nothing beyond that, you use the dividend. But if you have a pretty confident in yourself about this growth, you factor growth in there. If you're pretty confident about your measure of residual income, you put the residual income there. So basically, all these models involves progressively more data. So which model you choose depends really on how confident you are with your estimation versus everybody else's estimation. And then also, these models rely progressively on more and more specific assumptions. So a model is only as good as basically how reasonable the underlying assumptions are. So I want to kind of walk through this and point out the key assumptions that make it work, and that's something that you should be aware of. I think I should be aware of, I think. Well, so that's the underlying assumption, underlying the so-called, once you understand the underlying assumption, you can understand the strengths and limitation of each models and kind of possible ways to alter this model to fit your own need. Okay. To understand those models, I want to start with this, which is the most popular, is the earnings. Right now, you start with basically your PE model. You take the earnings, forecast earnings and earnings growth model. The top one is constant growth model, is the most widely used. And then I want to compare that first with the OJ model, finite horizon version, just to pinpoint exactly the underlying assumption of these models and what makes one works better or worse than the other one, or kind of trying to understand the rationale behind it. If you think about, to understand this OJ model or earnings growth model, the starting point is this constant growth model that widely used. Once you forecast earnings and then constant growth path, you take the dividend, discounted minus the G, that's the value. So to understand this OJ model difference, you need to understand, what's wrong with this constant growth model. One thing is that you can very simple example, that you all know that basically dividend affects earnings. In the sense you can have, these are the same firm. One could be you have a full dividend payout and earnings have a constant, basically no growth. And the other case is just you don't have a constant payout, you withhold it, that by itself will create earnings growth. So that, in my mind, is one of the major problems with this constant growth model, is that this growth, actually is borrowing Trevor Harris' term, is this some firms, what you need to differentiate is this growing and this growth firm. Basically, some firms have the growing earnings but doesn't add value. And some firms, on the other hand, actually have true growth. That is the problem. In this model, there's just one growth G. And if you think about it, if you really have a constant growth firm, 10% discount rate, you can easily do a calculation. There's a relation, simple relation between the G and the dividend payout ratio. K. You pay less dividend, you have higher growth. So basically, in one sense, is if it's a constant growth, this G, a lot of people will believe it matters. That's the key thing to separate one firm from the other, is one have high growth, one have low growth. But if you think about the steady state with this growth, if it actually capture is just nothing but growing, then the whole point is disappeared. And for instance, if you have that this company is growing, then this G doesn't really matter. That is, all you do is to keep the dollar in the firm and grow at basically the discount rate. So on the other hand, you'll say, that's not really the case. I look at the firm that earns a rate better than the benchmark. Then if that's the case, you got to ask yourself, why do you have a constant discount rate in the first place? If the firm is earning a rate beyond the benchmark, they should keep more basically earnings or dividend in the company rather than keep it constant. So that is one of the, in my mind, of the good thing about this earnings or the OJ model is they have a different way to link earnings and to price, which allows for the difference, to capture a difference between this growing aspect and the pure growth aspect of the company. Well, to understand that, the first thing, which I think I want to emphasize the so-called accounting aspect, is the first thing I like it is to utilize this key aspect of so-called smoothing, accounting smooth earnings. And that's the underlying idea, I think, behind this model. That is the first term. If you think about accounting, that we have this aspect, when we recognize earnings, we may not recognize all the thing, 10 years down the road, but we have this tendency to pool in everything, we smooth out the cash flow and make it sort of equal. If you think about the accounting, when we do revenue recognition, I remember Sandy at Columbia used to say, the notion of revenue is basically the amount of inflow of cash the firm can get at the current level of operation. So basically what's built in the accounting is the idea we want to capture something permanent. If the accounting is successful in doing that, then that's what gives rise to the first term, where you capitalize these earnings and use that as the benchmark. That's the smooth term. If you have perfect smoothing, basically everything is captured in there. That's the aspect of it. And the other thing is this model, what it separates is, if you look at the ZT term, is the earnings, there's a dividend. Basically, if you look through this model, what it allows is that the separate dividend from the value. You basically ask yourself when you do the forecast of value, how much of the earnings growth is due to dividend reinvestment? Take that out. The rest of the growth is what you care about. That's what this basically the model is trying to capture. And the other thing, I think it's kind of a misunderstanding that to think this model, especially compared with the residual income, I think think of this model as something just kick away the book value. which I think it's actually not 100% true in the sense the book value is just buried in the background when you capture this residual, the abnormal earning. In any way, I mean, the way I think, one of the contribution of either residual income or this model is basically bring into focus this idea of the importance of book value. Really, that you don't just forecast, just look at earnings and you forecast earning, discount it. One of the important facts of this model is to force you to think about where does those earnings come from. It comes from the book value and how much book value growth affect the future earnings growth. And that's actually have factored into several of the empirical paper has been successful in, teasing out the implication of that. So, and the last thing I want to say is this model, flexibility of this model is, I mentioned before, allow the separation of so-called the growth, the short-term growth and the long-term growth, which basically separate this growing and the growth aspect. What I mean by that, basically, if you look at the model, there's a long-term growth in the so-called residual abnormal earnings. That long-term growth of abnormal earnings, chances are, is you assume this basically there's an abnormal part of the earning will keep growing. And that is not excess profitability. It's not because the firm can earn excess profit for infinite period of time. That's just driven purely by accounting, conservative accounting. In the sense that's something that you need to keep in mind is you do accounting conservatively over time. That will translate into a so-called seemingly abnormal profit. And that part is going to just keep growing with the firm. And you put that aside and you look at the short-term growth, the difference in this model, the short-term growth part capture the so-called real excess growth in earnings profitability. So that in mind, the bottom line is in that model, what you want to keep in mind is for that model to work, one thing is you basically look at the earnings, forecast 1 year down the road, capitalize that one. One thing, the key assumption is this 1 year ahead earning really captures fully all the earnings potential of the asset that you have. Okay? And the other one is the ZT change basically from 2 years down the road earnings and 1 year down the road earning, the change fully reflect the impact of conservatism. So that's this two terms capture so-called the value creation and map that into value. And that's something that, keep in mind, the reason is that you might want to think, this is what makes it work, and what circumstances it works, what if it doesn't? What it makes it doesn't work is what I call it limited smoothing. That is, even though ideally accounting, we recognize all the future earnings, smooth it out, and recognize today, that's not exactly how we work in accounting. A lot of this, like high-tech firms, internet firms, all this customer-driven, customer satisfaction, the future growth, you cannot really pull it to 1 year ahead earning because of this, the reliability constraint. So recognizing those problems, what do you do with it? Then you can actually keep that in mind. If you end up in a situation where you believe 1 year earnings down the road may not really fully capture the impact or the earnings generating ability of this firm, what you do, you can easily modify it and say, suppose this excess earnings growth, this is a simple linear model. You can say, suppose this excess profit first kind of gradually reverse to a mean, and then after that one is going to be driven purely by this conservative aspect of accounting. So you can use this model instead of the single AR1 process and then crank out another model. But again, all this model is some people believe, I can make different assumptions and then have a different model, 15 different models on the table. Again, really depends on your purpose. If you believe that I really don't feel comfortable forecasting how much this excess profitability is going to go down, say it's going to last 5 years, 7 years, then you might as well just use this 1 year ahead earnings and just go with it. If you feel comfortable that you think that excess profitability is going to last for 7 years and then goes to reverse the industry norm, that's the case, then you use a more advanced, more fancy model. So it's not always the case that the model, the fancier the better. And that's basically what leads to, rather than, I think that's also what gives rise to the need for this model rather than you forecast to infinity. Okay, so this is basically just recap all these earnings models. You start with earnings, dividend ratio, and then you have constant earnings growth. You have the OJ model, and you have the discount. Basically, if you stretch it out to infinity, everything is the same. It's all discounted dividends, and there's nothing. The only thing that you need all this model is you cut out shorter and shorter in your horizon, and the model uses less and less of components. And so that gives you the sense of what makes a model success, which I believe the key thing is with limited number of input, you can capture the majority of the impact which affects the value of the firm. That's what basically drives one model better than the other one. And I think one of the things, the key driver of this OJ model is the concept of earnings smoothing. That we have a smooth earning and use earnings 1 year forecast capture the majority of the impact, what affects the value of the firm. Okay, again, this is just, when you choose the models, basically involves a trade-off between the cost of the information and how confident you are with all those models. Next thing I want to talk about, a little bit switch gear, that's the earnings discount model. The other side of all the model is basically emphasized on the balance sheet. That is the residual income model. So to understand that model, to really keep in mind what makes that model work is rather than the so-called permanent income kind of concept of accounting, where basically we do accounting, that's the earnings side. On the earnings side, we do accounting, emphasizes put on the income statement. That's what they call it, income statement approach of earnings. I don't care that much about the balance sheet. All I do is to smooth out these earnings. What's left on the balance sheet is sort of something left over I use to smooth out these earnings. On the other hand, the balance sheet approach is basically you get the asset right and forget about the income statement. I think this balance sheet approach of accounting is what drives out behind the so-called residual income approach. Basically, you take the historical cost, which is not exactly fair value, but roughly close enough, and then you use the residual income to make the minor adjustment. Sort of the whole thing anchors on the balance sheet. All this, one of the things is residual income model that you all aware of is the impact of conservative accounting. That is, the key thing with residual income is rather than to get a good value of the firm, you need to tease out exactly what's the excess profit. The actual excess profit the company is earning above beyond the benchmark. But that is also, just like conservative accounting can mess up the earnings model, conservative accounting mess up the balance sheet-based model too, is basically if you can just do the math and say if you have a conservative accounting, have a growth firm, over in the long run, what's going to happen is the book rate of return is going to exceed the benchmark. So essentially is when you have a conservative accounting, you reduce the earnings, but you also reduce the book value. In the end, the impact on book value is larger. And then in the end, if you calculate the book rate of return is going to be higher. This is what happens if you look at the firms, look at the book rate of return, generally it's around 17, 18%. On average, it just cannot be all of that is due to excess profit. So the challenge is if you want to use this model, you need to really kind of try to separate what I call an economic value added from the value added basically just by accounting. There are ways to expand the residual income model to attack this problem. This is where various research, different kind of research has been done in this area to say how do we take care of this conservative accounting problem. This is where different models people differ. As some people say depends on my model, you throw in current book value. Depends on a different model, you throw in lack book value. Or, but really depends on what do you believe which one is basically suits better. But roughly speaking is whatever you do, you need to take out the excess profit and separate out into two components. One is driven more likely by accounting. The other is more likely to reflect the true excess profit of the firm. That's, when you have conservative accounting, the average book rate of return is going to be higher than the discount rate. So, or you can just use another kind of AR1 process to kind of use a more complicated model and take care of this problem of conservative accounting. So a little bit further extension. That's why, that's one side of you take this accounting-based valuation model and try to deal with this, growth and growing or true excess profit versus accounting-created excess profit. And these are some of the papers that deal with other issues. For instance, changing in interest rate, or basically, how to deal with conservative accounting. Shall I put in the book value? Shall I put in the lag book value? I'm going to just quickly, one thing I want to mention, forgot to mention at the beginning, is I'm going to just talk about because I'm going to talk about a lot of this is basically research done by my colleagues here in this area. I don't think I have a comprehensive list. It's not meant to be comprehensive. And if I forgot to cite your research, don't get angry. It's just purely reflect my ignorance in this area. I tried my best, but as always, best is not enough. So basically compare the earnings growth model, residual income model. Really depends on what you believe the accounting approach. Is it a balance sheet approach that's better, or is it income statement approach or better? If the accounting is shifting from the income statement approach to a balance sheet approach, how does that affect your valuation model? So you need to all keep that in mind. How to compare now? We talk about as if there are two camps. There's the earnings growth model. There's the balance sheet residual income model. Now, which one do I choose? Okay. One thing depends on, as I mentioned, the accounting approach. Is it balance sheet or income statement? The other way you can think about it, or sometimes I choose to think about it, actually boils down to the same thing in the following sense. You can do some manipulation. I'll say residual income model is basically you capitalize kind of the 1 year future earnings, and you do some subtraction based on the book value. Or the other one, the earnings growth model, is the same thing. You capitalize future earnings with a growth, and then you do some adjustments. So what they basically differ is this adjustment. What they're telling you is essentially this. You start with the 1 year ahead earnings, and you assume they grow constantly, and you discount it back. Okay? The two model differs really what you believe that you should make the adjustments. Think about it. If you forecast an earning and let it grow constantly, the first residual income model tells you that's not okay in the sense some of the earnings you believe it grows constantly, but part of the earnings actually you shouldn't forecast to grow constantly, like those in the book value. Basically, you believe everything in the book value, kind of like the dividend that you keep in the company, that only earn a benchmark rate. So if you adjust for this dividend reinvestment, that one does not grow as a G, but grow as a lower rate. And that's why that model, the way I think about it, is basically you start with future earning, assume a constant growth, but you subtract those portions that's not really contributing growth to this firm, which is, you believe, is a function of the book value. And the other second model, the earnings growth model, is basically the same idea. I forecast earnings, assume it grows constantly, but some of the earning actually you shouldn't forecast it to grow that much. Some of the earnings, suppose that's actually already impounded in your permanent earnings calculation, and those growths, for instance, the earning you choose to keep in the company, that only earns a benchmark rate. So if you adjust for dividend reinvestment, that part of earning shouldn't be grown that much. So that's why the second component basically is just a different way to adjust for that belief. That is, you don't forecast every earnings to grow. So the way to look at this one, I think it's actually pretty intuitive and easy. All these are just modification of what we have before, this constant earnings growth model. Now you believe some of the earning doesn't really grow that far. You shouldn't forecast it grow constantly. You take that out. Maybe it's a function of book value. Maybe it's a function of earnings. So a little bit, this is really a little bit target on practitioner is pick a model, general rule of thumb, cash flow model, in my mind, I think works better with stable firms or when accounting is really lousy. That is, forget about, when you have a lousy accounting, forget about earnings or book value, just take cash. Residual income model generally tend to work better if you have significant assets on the book. Now, if you don't have the asset on the book, I think it would be better to switch to an earnings approach where if you believe earnings can capture the majority of the kind of true earnings power of the firm. Now, the second thing, I have 10 minutes. So looks like I made the mistake where the first time you teach a class, you made the mistake, you over-prepared. So I'm going to speed up. All right, so implementation. There are basically two things about implementation, the two issues. One approach is you calculate intrinsic value. That's you take this model, you calculate intrinsic value, you put in your own estimates, growth estimate and discount rate estimate. The other side of the approach will be so-called reverse engineering. You take this model, the other way to use this model is to use this model to reverse engineer, basically take the price and see what's the impact the market seems to be using to basically value this company. Again, this is an issue. If you look at this one, you think there's a contradiction, sort of. I'm trying to find an intrinsic value. On the other hand, I use this market price to reverse engineer some of the key components. It will look less kind of a controversial if you keep that in mind. What you're trying to do is trying to infer something that you believe you don't know as good as the others. So this is the first step. You reverse, you take it out, and then your second step, you're adding something that you think you know better than the others. You attract, and then you arrive at this so-called value of intrinsic value, and then you trade based on that. Implementation issue, there's a couple things I want to just, one important is to separate the financial and operating asset of it, and the other thing is, whenever you have a share repurchase, if you wanted, Steve has a book and Jim has a paper on this one. Large sample evidence on residual income. There has been first of a group of papers. Basically, they say the paper has some benefits, but it's overall not that encouraging. But we have recent works, basically like Choi or Hanlon and Pope, saying that a lot of this prior conclusion is really that if you properly adjust for accounting conservatism, and put it in there, you can reduce the bias quite a bit. So there's some new hope there. And then there has been people compare this model with cash flow, and then using this model for fundamental valuation. And the other set of models, basically, rather than apply these models, basically take this idea that a lot of things all this model seems to be bring forward is this idea of book value actually plays a key role in forecasting earnings. That is, rather than just sit there and look at earnings as if earnings come out of nowhere, that you realize there's a role to forecast book value growth, and that, for instance, asset growth tend to lead to less growth in earnings EPS numbers. So you factor those in. And this is a Nisium and Harris paper, a working paper, where basically they try to use this model to separate, if I understand correctly, the growing and the growth aspect of the firm. The other side is is when I talk about the reverse engineering aspect. Bottom line is, this model seems to be on this side of generate more exciting results. Basically, is if you want to do reverse engineering. And this is where also we the finance people tend to find it kind of exciting. Is you use this model, reverse engineering. Peter has a couple of papers in this area. You actually got pretty sensible estimates of cost of equity capital and growth, rather than just you use the traditional constant growth model. So that actually shows the power of what a good understanding of accounting can bring to the table of the research. So the last point I want to talk about is what I call it remaining problems. Since Jim and Peter are here, so I'm going to just pick on them. Basically, it's not picking on them. It's sort of a problem which I look at this residual or this accounting-based valuation formulas is I believe the true thing that can give life to this line of research or to give life to this usefulness of the model is really the underlying accounting aspects that drives it. Basically, you understand the accounting, what makes this model work better than the other one, rather than it's just general twist based on the dividend discounted model. It's the accounting that drives its success. So what I think it's, for instance, when Jim's paper, you can say, this YT works for anything. It's, you don't have to cash accounting, accrual accounting, anything. But to really understand the true kind of thrust behind all these models is you really need to understand the accounting, like permanent accounting, when that makes the model work, and when the accounting doesn't work, what do we need to do to modify those models and make it work better? Like the other one, I take it out of Pope and Wang recent paper, where you make the assumption, for instance, price equal the linear function of earnings, one component of earnings and book value and dividends. And you got to ask, one thing you ask yourself, what makes the book value as a linear function of earnings and dividends, and book value, market value equal to linear function of that one. So what we need to bring, I think, more to the table for this line of research is this idea, what's the accounting that drives the result or drives your assumption underlying your results? I think it's actually, Jim has this paper 2006 where they talk about it, basically. What kind of accounting, if you do it there, you will have this abnormal earnings growth. And that also, I think, is an important area where, starting there, accounting may be able to say something like what the accounting should be doing if you trade out this relevance and reliability, what a good accounting ought to be to capture basically all the essential information with less kind of items. That will help people to do the forecast and do the valuation. So summary, I believe research in this area has generated an array of so-called accounting-based valuation models, and empirical research provides some preliminary support for their usefulness. Want to emphasize is, this idea of so-called picking the right model is important. Keep in mind the so-called model misspecification. You really need to know what's the underlying assumption that drives this model, make it work. If it doesn't, make your kind of modification. And the other thing I want to say is this literature, I believe, is relatively young, really. Is if you look at, try to bridge this one, this is sort of what we're trying to do. Take this model and use it in evaluation, then you will realize a lot of the issue that we're not really addressing. We haven't been able to address it. What I put it there, sort of kind of running against the crowd. What I mean by that, one thing, for instance, if you think about it, all this model is you do the forecast, you get this so-called intrinsic value. One important issue that what do you do with it? You take, precision, then you ask yourself how long it's going to actually for the stock to revert to that kind of intrinsic value that you forecast. Is it 10 years, 20 years? That kind of aspect is totally absent from all this research, which I believe is very important. If I'm a fund manager, I got evaluated in December, and then I may not be able to actually take a strategy which won't bear fruit 5 years down the road, because by that time I might already got fired. So all this thing, one thing I want to keep in mind is a lot of this so-called price dynamics involves a lot more than just so-called intrinsic value. Price is something that depends not only on what you believe in, but to a lot of extent depends on what other beliefs. So there's this whole aspect, and some of them already get picked up in the finance literature. You got to understand the whole process of the pricing. Not only what you have to try to forecast what determines other people's forecasts. That shapes the speed of how the price is going to revert and what event can trigger this reversion. So a lot of those exciting things, I know, Jim would think this is sort of my secondary issue more, but a lot of this, price dynamic and all this are yet to be done in this research. That's how I view it. So that's pretty much it. Thank you very much.